There's little in the way of UK events or data releases this week, although the final release of the UK's second quarter GDP data is expected on Thursday. Joining me now to discuss what the future holds for the UK economy is Brian Hilliard, Chief UK Economist at Societe Generale. Brian, thank you very much for joining me. Now, there are still concerns about the fragility of the UK economy, as according to official data, things still look pretty bleak. What are you expecting from this week's revised GDP figures? Anything different from the figures we've seen over the last few quarters?
Well, don't forget, these are the second quarter numbers. It's the third and final estimate, so this will just be a refinement of the data we already have. I don't expect to see any change in the official sort of estimate for the second quarter at -0.5. More interestingly, I think we should expect that bounce from the Olympics coming through in the Q3 data. That's, I think, pretty well built into market expectations.
But what about the UK labour market? This is showing some positive signs of recovery, is it not?
It is, and in fact, the labour data are completely inconsistent with the GDP trends. Now, we know that the GDP numbers are distorted by a variety of factors, by the construction sector, which seems abnormally weak, by the Diamond Jubilee holiday. All these kind of things build in pretty easy to quantify distortions, and they're going to be absent in Q3. But the labour data do abstract from that in some way, and they're showing a pretty strong upward trend in employment. Now, that is only consistent with output growth rather than output falling. So I think that's the data I would choose to focus on, because I think it's telling a valid story.
Judging by September's MPC meeting minutes, what about the prospects of further policy stimulus over the coming months? Expectations are for an increase in QE and a potential rate cut both in November. Do you agree?
Yes, I do. I think the fact that for the last two meetings there's been at least one member who was seriously considering an immediate increase in asset purchases from the current target shows us the way the wind is blowing. So I think that in November we will definitely get a 50 billion increase in QE. I'm also forecasting a cut in the bank rate of 25 basis points, although the odds of that are decreasing after King's 34th right comments at the August inflation report press conference.
Moving on to discuss the funding for lending scheme the Bank of England launched back in mid-July. Firstly, do you think this was the next best step in the right direction to help get the economy moving?
I think it's an essential component of engineering a recovery. It is a clear problem to find that lending is not growing at all after so much money has been pumped into the economy through the quantitative easing program. And I think for small and medium-sized companies in particular, this is something that is really delaying their recovery. So I think it's exactly the right thing to do to try to get lending going.
It's still in its infancy, as you said, but what kind of impact has the funding for lending scheme had on the banking sector so far? And at the moment, is there much sign of banks passing on lower costs to household and businesses?
Well, it's far too early to expect any major impact. I mean, the scheme only started on 1st of August. The immediate impact will be to see changes in funding sources. There are other schemes offering cheap funding from the Bank of England. They're pretty much withering away. There's a special scheme called ECTR, for example. So I think what will happen is that banks will avail themselves of this offer of very cheap funding. That will be reflected in lower lending rates, but there's not much evidence of that to date. We do actually get a flow of data coming from the Bank of England on funding for lending and its impact on the lending aggregates. And indeed, already on the Bank of England website, there is data for July, and that shows lending growth on a year-on-year basis essentially zero. And that just underlines the task that the Bank of England faces to actually sort of get lending growing. It's from a zero base.
Just as importantly, potentially, how could this affect or influence the course of the housing market over the next year or so?
It should provide it with a little bit of a boost. The housing market is in a very weak state at the moment. Part of that is because the average mortgage holder or the applicant for a mortgage is dissuaded from applying because of the uncertain economic outlook, but also because of the terms on the mortgages, which are quite strict. The banks should respond by relaxing terms to some extent, either in terms of the interest rate charged and or the loan-to-value ratios. So I'd expect to see some positive effect from that, and that is one of the sort of two key focuses of the scheme.
Finally, Brian, what about the manufacturing sector in the coming months? While we saw a bounce in new orders in August, surely it does little to change the underlying picture of a fragile manufacturing sector facing enormous headwinds and downside risk.
Well, I think your interpretation is correct. The only modestly bright note is it's a little bit better than our continental European neighbours. I think that the manufacturing surveys are telling us that manufacturing output is on a modest declining trend. Export orders are weak, although not quite as weak as we expected, but both the domestic and the international environments are pretty harsh, and it's difficult for manufacturers to expand output in that kind of background.
Brian, thank you again for joining me. Some interesting comments made there. Now, for more exclusive interviews like this one, stay tuned for the rest of the day to Dukascopy TV. But for the moment, goodbye.